So a ceasefire has been reached between the US, Israel and Iran. Of course, there are many political reasons behind it. But remember Bill Clinton's famous line? It's the economy, stupid. Well, in this particular episode, we shall focus on the economic reasons behind the ceasefire, especially the US-centered economic reasons. Hello, my name is Abhinav Trivedi and you're watching Mint Explains. Now, following are the three US-centered economic reasons behind the ceasefire. Number one, surging US debt. Well, the US debt to GDP ratio is around 123% as we speak, with the total debt reaching above $36 trillion. There are already a lot of conversations and appeals from economists, businessmen across the globe to address the US debt time bomb, which would eventually impact global economy if it bursts. The world's most powerful country is running at a fiscal deficit of about 6.3% of its GDP, which equals nearly $2 trillion annually. To make matters worse, Trump-era tax cuts are adding another $400 billion to the annual deficit, making it around $2.5 trillion annually. Now, in case the Middle East war with direct US involvement was prolonged, it could easily surpass $2 trillion spent on the Iraq war, because that was many years ago. Analysts believe that the Iran war could have added at least $4 trillion over the next decade to the surging US debt. Had the war been extended, there was a high chance of the US Congress again pushing the debt ceiling, and that would have a devalued dollar yet again and push debt even further without any firm commitment on addressing it rationally. Economically, that would have posed a big challenge to the confidence that the US would be able to pay back its debts. The second reason was the US bond market. Bond vigilantes, as they are called by many analysts and traders across the world. Now, as per a report by Bloomberg on June 23rd, companies in the US and Europe cautiously waded into credit markets, launching a series of debt sales as they looked to lock in relatively low borrowing costs and before retaliation from Iran jolted bond yields. You heard that right. Iran's retaliation efforts, if they would have spiked further, could have potentially pushed US government bond yields higher, more than 5% as per certain economists, particularly if Tehran disrupted shipping traffic through the Strait of Hormuz, which is a crucial passage for global oil and gas cargoes. That move would have hit the world economy very hard. This was one reason why US President urged oil companies not to push the prices higher in the midst of negotiations. Trump posted on Truth Social, "Everyone keep oil prices down. I'm watching. You're playing right into the hands of the enemy. Don't do it." Now, higher oil prices in this scenario is exactly the opposite of what US President wants. Now, high US bond yields would have been extremely bad news for the Trump administration dealing with high borrowing costs as US Fed delayed any further rate cuts in its last FOMC meeting.
Well, yes, it depends again on how long. I wouldn't be surprised for bond yields to spike from here. So there's the first part. So yes, possibly I'd keep an eye out for, say, 4.5% for the 10-year. And if it goes through that, then maybe you're looking at a little bit higher. It's just a work in progress to see how long it rolls. I want to keep an eye very closely on US equities and US dollar. And the overall situation as far as debt ceiling, well, there are certain constraints there, but I'm sure that in a time like this, I don't think that Congress would sit on their hands. They'd certainly look at supporting President Trump.
The last reason is the threat to the US dollar. According to a report by the Official Monetary and Financial Institutions Forum, the dollar, the most popular currency in the last year's survey, fell to 7th place this year, with 70% of those surveyed saying the US political environment was discouraging them from investing in the dollar, more than twice the share a year ago. In currencies, the euro and yuan stand to benefit the most from diversification away from the dollar. A net 16% of central banks surveyed by OMFIF said that they plan to increase euro holdings over the next 12 to 24 months, making it the most in-demand currency, up from 7% a year ago, followed by yuan, of course. But over the next decade, the yuan is more favored, with a net 30% of central banks expecting to increase holdings, and its share of global reserves seen tripling to 6%. Now, clearly, an extended war with Iran would have had a catastrophic and direct impact on the status of dollar as a safe haven, international currency, and global economic heft for the United States. This is a developing story, ladies and gentlemen, as more geopolitics and economics gets into play. And we at Mint shall keep you posted. Goodbye and Shabba Khair.